Away, I'm like, wow, that's really impressive.
AEW is an investment advisor. We manage about $50 billion.
50, 5 out.
Of real estate around the world. Half of it's in the U.S. About 40% of it is in Europe, and 10% of it is in Asia. Manage money in all return and risk spectrums. So
And here in Boston?
here in Boston, that's our U.S. corporate office, and it's also our international headquarters. We have about 225 people in Boston.
Beautiful, thank you, Mark. Cappy, good morning.
Hi, good morning. I'm Cappy Dami.
Hold it closer if you would.
Okay, Cappy Dami with the Davis Companies. And we are a local operating company that is, I guess, maturing into the fund investment business. We have probably over $2 billion in real estate, 11 million square feet. We're a mini-me of Mark.
Where? What is your
The bulk of it
footprint?
is sitting here in the Northeast, mostly in Boston and Fairfield County. But we are, the debt markets have taken us to other parts of the country, and we can talk about that.
Great, Cappy. And Rachel Edwards of Win Development. That is a word you're going to be hearing a lot tonight. Win?
Yes, win, win, win. So I am the Vice President of Acquisitions for Win Development. We are a multifamily developer with a focus on affordable and mixed income housing, predominantly through the adaptive reuse of historic structures or taking rundown existing
Like
housing.
what that we might know around here?
The old Pickle Ditson building down in Mission Hill. That's now a mixed income building with everything from homeless set-aside to market rate units, penthouse units. And the Baker Chocolate Factory in Dorchester Lower Mills.
Beautiful, thank you, Rachel. Scott, morning.
Morning.
All right, explain, you see the drill here.
I'm kind of the David amongst the Goliaths. For those of you who read Malcolm Gladwell's new book, Mavai is a relatively new 2-year-old entrepreneurial real estate platform. As background, we access probably half of our capital from high net worths and family offices, and then half of our capital actually comes from some of the other panelists or the likes of some of the other panelists.
But you haven't always been a David. What did you do before that?
I actually bring an interesting perspective because I spent about half of my career as an allocator of capital, giving it out at the likes of Bank of Boston and AEW, and then the second half of my career I've been a GP promoter of capital, taking in money at Taurus Investments in Novaya.
Beautiful. Back to Peter, Intercontinental. Morning.
Good morning, thanks for having me. We're Boston-based. We've been in business for a little over 50 years. In our original constitution, some of you will know our local deals when we were a construction company and developers. About 20 years ago, we decided we wanted to be more like Mark, and I don't mean that in a gratuitous way. We model after AEW and TA, and we've tried to grow into an asset management firm. So today we're a registered investment advisor, registered with the SEC. We're investing our 6th fund. We manage about $2.6 billion on behalf of about 250 institutions.
Beautiful, Peter, thank you. This is, ladies and gentlemen, your equity panel, and back to the most estimable Andrew Pearlstein of Sci-Fi Shaw.
Thank you, Mark. Welcome, everyone. Thank you for joining us. I asked this of the debt panel, and I wanted to start off with this. Pricing. You think we're too high, and do the real estate fundamentals support the prices that you folks are seeing out there as you look for either investments or acquisitions? Anybody feel free to start? Peter? Go ahead.
Not to duck the question, but I don't know that there's too high and too low. What I think has changed a lot in the last 20 years is there's so many different appetites for capital. Mark has multiple buckets that require different coupons and different returns. Cappy, I'm going to guess, is more mid-teens driven and looking for value. And then you might have a public REIT that is thinking about FF&O and multiples on their stock price. And that's pretty different. The other thing that's different is everyone sees every deal. If you go back 20 years ago plus, if there's a certain type of deal, Norman Leventhal saw it. If there's another type of deal, Harold Brown saw it, Ron Druper, etc. Today, we all see every deal. All of us do all property types. That's kind of new. And so at the end of the day, it depends what my investors want in my vehicle. So what for me is, a 9 and is gold might be too low for Cappy's fund, and vice versa.
Kathy, you want to?
I think we've been net
Hold it close,
buyers.
close.
We've been net buyers in this market, and we've also been net sellers. Actually, we've sold quite a bit in 2013, primarily in the tertiary markets. Properties that we bought in '09 that we got in very, very, very cheaply. We got them stabilized, and we wanted to capitalize on that. We've also been buyers, and I think there are times where we're struggling. Often we're struggling. We're a 15 to 18, as Peter referenced. That's what we're looking for. So we're trying to find inefficiencies often. Sometimes that's different places in the capital stack. Sometimes that's we're having to look further out on the risk spectrum. But we're finding it. And I'll tell you, sometimes it depends on your view of the market, of the submarket. So we're familiar here with all the trades that have been going on in Burlington. And I know Mark worked hard on Burlington as well. And I think some people think that maybe AW might have overpaid, but I don't. I think it was a great deal. I think when you look at the underlying rents that were in that project, they were near all-time lows. A lot of the rents that have been negotiated in there were negotiated in '08 and '09 when the world was in a financial crisis. So the rents have a lot of room to rise. He's got a little age he's got to deal with, but he'll deal with that. So I think it's all opportunistic depending on where you are and what you're seeing.
But I think the way the question was framed, I do think we could all agree, in or out, that the capital flows have outpaced the leasing fundamentals and the market rent momentum at this stage. So I think it varies by location. If you want to stay close to home and where everybody else wants to be, you need to be betting on a lot of future rental income to justify your underwriting. Yet if you move if you want to kind of segment it by asset class or property type, we're finding a lot of 9.5 yields out there on stabilized industrial, where it's a little bit less picked over. You got to go to Taunton, you got to go to Franklin, you got to go to places that are 40-minute drive time from here, but they happen to be the right locations for distribution. So I think the answer is a tricky one in terms of you have to begin to kind of bisect the market and figure out what locations you're talking about and what property types you're talking about.
Yeah, I mean, I'll take it a little different ways. Two things. I think you asked a question in the last panel, where are interest rates going? I think interest rates could be lower for a long, long time. I mean, if you look at the U.S., our employment participation rate is the lowest it's been in over 35 years. And I have this argument with our research people at AW. It should be higher than ever because the baby boomers, people like myself, you keep on reading how they have no savings, how they're going to have to work longer. So that employment participation rate probably should have gone up, not down. So, we talk about getting back to full employment, but there could be a new definition of full employment. So I think wages are going to be constrained for a long, long time, which means interest rates, because, wages makes up so much of the economy, could be constrained. And then I look at it, and, Kathy brought up the New England Executive Plan. The interesting thing is that wasn't done by the Opportunity Fund. And I highlight this because there's new capital coming in that is doing an existing capital that is doing things that they've never done. We have core clients building core. You have private REIT, you have foreign money, and as we meet with all these people and we try to ascertain, is it momentum money or is it sticky, more permanent money? We're coming to the conclusion that it's going to be here longer than you think, because we may look at, a 5 cap as being low. If you go to Asia or Europe, a 5 cap has been high. That'd be a good return to get going back 20 and 30 years. So if we really are going to be part of a global capital system, I think we all may be surprised that these rates could be lower than you think longer term.
Right, just to kind of build on what Mark said, I agree, and I think the same story is playing out here in the U.S. The average U.S. public pension plan, for 100 years thought in terms of 60-40 allocations, 60% public equities, 40% fixed income. And you're seeing a secular shift where most institutions are lowering their bond allocations and involved with a hospital institution that lowered it to like 11%. That would have been unheard of. That'd be seen as risky and dangerous. And why? Because in a yield-starved world, you're sub 3% for your bond allocations. So where are you going to get your yield? Pension funds are loving us, and then if you add to that that they've had good stock performance for a couple of years, suddenly they're chasing denominator allocation. If they're supposed to be at 8% real estate or 9% real estate, they have more money now. If I could just ask a question, because is pricing too high? And there have been some significant transactions in the Beltway, and even TA bought locally. You don't see them do that a whole lot. Isn't the question with a basis of $200 and up in Burlington whether rents will support it? And so, my question is, I don't know how you feel about that. Isn't that what you're hinting at, Scott? That you don't know if rents will go there?
Yes. But I may show up there. I just might be a laggard. I mean, I'm watching very closely, but I don't think a year ago I felt as comfortable that you get to the net high teens that you need to be at, if not net 20, to justify some of the positions.
I'll answer the question very definitively. Absolutely, prices are too high. But I'm also approaching it from a different perspective. As a tax credit developer, we're limited on the federal and state subsidies that are available. So that is really what drives our underwriting. And so the markets where we're strong are usually typically in the tertiary, the emerging tertiary markets. And now capital is out there in these markets that hadn't been there historically. And so it's becoming very, very difficult to rehabilitate old property that has typically served, the working class families, and going out and finding new products to bring into those programs. I'm finding it very, very difficult to compete against market rate money.
So let's look at, given that intro, let's look at your parameters or strategies for investment decisions. Talk about whether it's a JV deal, a preferred equity, the type of control that you need, structure 90-10, 95-5. I want to talk a little bit about how you structure your deals, a little bit of control, and also about your buy, sell, hold parameter. I think it'd be an interesting one because you'll all have different perspectives based upon the type of investment decisions you're making. So, Scott, why don't you start and we'll go down the line.
I actually come at this from the other side, so I'm the 5 rather than the 95 in the game. I think what I'm seeing right now is a lot of liquidity, a lot of flexibility, preferred return, cost of capital from the block equity coming down, promotes getting a little bit more generous. Again, I just think it's a function of how much money is in the market right now.
So again, the tax credit deals, the tax credit equity investor in the deal is looking for a different type of return. They're looking for a dollar for dollar reduction on their tax return, depreciation, and a share in the cash flow. So the debt is a real small part of that, and our hold is 15 years because that's the tax credit recapture period. So we're holding deals for at least 15 years, and we're using long-term rate fixed financing to support that.
Kathy, let's talk about it from your perspective, and Mark and Peter, because I think maybe you'll have the same view, but let's see what you said.
Well, we're a hybrid. I mean, we are often doing deals with institutional capital partners. We're, in some cases, investing in the Scott Tullys of the world. So we're right now playing in both camps. I would say in the early part of the cycle, so a lot of our Fund 1 deals, we were sourcing them. We were finding operating partners if it took us outside our markets. And we were wanting 25 to 30% equity investment, but not everybody can do that. That has to be a well-capitalized operator. We were always wanting control, major decisions. We want alignment. We don't want someone feeing the deal to death. I mean, we want to make sure that the equity that's going in is that relationship between the fees that they're taking out. We were looking for alignment. That's on the JV side. On the other side, it's probably all the opposite.
You sound like a lawyer. We could say, well, if we represent the buyer, we'll tell you this. If we represent the seller, we'll tell you that. It's perfect.
I don't think there's a set answer to this question. You got to start there because I think you first got to look at is the capital enabling the deal, or is the deal really off market. You know, and what we're seeing in this market, there's very few deals that are really off market, and the capital is more enabling a lot of money to do it. Now, that doesn't mean there isn't money giving higher promotes today, because, you know, and I think it's a dangerous game, because I hear all the time, well, this is our return expectation, so it doesn't matter if I earn more than that. As Peter will tell you, being in business for 50 years, and AEW being in business for 35 years, you only raise money if you produce returns. So when you give away all the upside for the deals that work and have all the downside for the deals that don't work, you won't be around that long. You know, there'll be cycles. So and the one thing I would say is what we're doing, and we have minimum multiples now to get to higher hurdles. I mean, in my fund we just finished investing, we sold 14 properties, owned them less than 21 months. Doubled our money, and you know, the minimum multiples are probably in a 175, because if it's market action, doesn't mean there isn't execution, but if there's market action, there should be a different promote. And you know, we don't give up control over major decisions. You know, as I said, we're in the business of raising money, and in an environment where it's been hard for organizations to grow their assets, we see a lot of people wanting to hold the assets, whether because there's more upside, whether the fees are coming off of those assets are important to the operations of their company. So giving up control, you know, if you look at what in prior cycles has got AW a little bit in hot water with our investor base, it's been that.
I can't add much to the conversation in terms of structure. I'd echo what panelists said. I would say we wouldn't want stock to be at 5, we'd like them to be at 10. You know, at 5, to Kathy's point, 5% of the equity in the deal, he's probably taking most of that out in fees. So we want a little pain in the deal and blood in the deal, as they say.
One of the other things I think that Mark and Peter both touched on that's interesting and might have got lost along here is the game is changing a little bit. When we grew up in the business, this real estate was kind of a bond equivalent asset class, with bond-like characteristics, inflationary protections built in, blah, blah, blah. And then it became an equity product somewhere along the way. And then the holding periods began to tighten down from 10 to 7 to 5 to 3, right? Which everybody like Mark is turning their capital at lightning speed. That's very hard business to do over time in an equilibrium market. To be able to come in, identify value, create value, hit your business plan, and get out in 3 years. It's always been one of my frustrations is the compensation was tied to IRR hurdles, and everything was just in, out, in, out. My investors, when Peter asked me to co-invest 10%, it's difficult for me in part because my investors don't find reinvestment opportunities readily. And we're selling in that 3rd year, and they're still a buyer. We created a business plan, they'd rather finance it out. There's other ways that they want to play. So maybe I don't know if we can build on that a little bit, but I'm actually in love with the fact that my guys are now looking at the world at 5, if not 7, and at times 10 years, where you can get all the way through a rent roll. If you bought the right building in the right location, you get a chance to really exploit the opportunity rather than to catch a little bit of market movement and flip.
Yeah, I mean, the one thing that's interesting, and I'll take what Scott just said, he said his investors. So what he basically said it wasn't his money. And, you know, so we don't give any credit to 5% when it's someone else's money. Because as Peter said, we want alignment of interest. So if people are syndicating their GP, they have to have real skin in the game themselves, or it better be such an attractive deal because, you know, we all want alignment. We all want alignment, but that doesn't get the
We have exactly as much in ours as you have in your fund. We line up with our outside investors at exactly the same ratchet percent.
Yeah, but we're a registered investment advisor, and you know we'll be out of business. I mean, I hear what you're saying. Yeah, you're a local entrepreneur. There's a different regulatory environment that you need to.
I'm trying to bring an entrepreneurial prism to the discussion. And if you put a 10% co-investment requirement in front of people, and you want them to produce a couple $100 million a year of smart business, that's an overwhelming requirement for an individual or a small partnership. And I would just caution you that you crowd out entrepreneurialism from your own sector at that point. They have to have access to angel investment capital themselves.
On the structures and JVs, and then I'm going to come back to hold period. One hope that we've been putting in a lot of our documents are some kind of protections for construction cost overruns, you know, where there's a trigger at some certain percentage, and if there is, there's something punitive to the operating partner. Because that's kind of the biggest risk in a lot of these deals. You go in often on not fully drawn designs. We've learned to not take entitlement risk. We used to do a lot more of that when we partner, and we're trying to put that on the operating partner. Just on the hold period, we've changed. You know, our first 4 funds were closed-end, so the idea was to IRR out maximally in kind of years 3, 4, 5. We've moved to an open-ended fund structure to just explain why, and so therefore we have a hold bias. It has kind of everything to do with, you see a lot of vintage year randomness in the private equity and the real estate world. Even some of the best fund operators have clunker funds. You know, frankly, in our first 4 funds, we had a very challenged fund, and we think we're good at real estate, but it can happen. And why? You know, from idea conception to raising money, and we're not paying capital where we raise our fund on an email. You know, we're out with knee pads for kind of 6 to 24 months. And then you're investing the capital for 24 to 36 months. Funds are 7 years, sometimes 10 years, and we always sneak extension periods in. So a 7-year fund from idea conception to full harvest is 11 to 14 years. And so even the best funds, pick on someone who, there's no way they're in the room today, say Shorenstein, great real estate operator. They've had some tough funds, everyone does. Why? Our leases are 5 or 7 or 10 years. It doesn't necessarily stack to the timing I just took you through. So we like the idea of an open-ended fund. It gives us some freedom to think prospectively and to treat real estate as it should be.
It's hard. I mean, some of our clients, and there's someone in the industry that's trying to go from a closed-end to trigger to a core fund. I mean, in my last fund, I have 700 apartment units in Santa Monica that we bought from lenders, and it's all new construction. Every one of the clients in that fund would die to own those long-term, but I can't own them long-term, because that isn't the, prospectus and the objective of the fund.
That's not your investment mandate.
Yeah.
So Mark, can you see a future where you're raising, more of a manufactured core, an evergreen type fund? So it's not quite core from the get-go, you're taking risk on the initial, and then you build this beautiful thing, and then you're holding it for...
We're doing it with a few separate accounts. We haven't yet done it in a fund
I think you'd be very successful if you
I think we would. Like I said, right now, I just don't think the investor base.
Yeah.
Because the problem is everybody has different objectives and different needs, and they allocate their capital based on, I'll call it a barbell. So they may want that capital back, and they don't put it out as forever capital. So that's where it makes it hard, and then if their objective changes and now they're in a open-ended fund, unless you have liquidity, which today the funds have liquidity. Core funds, you can actually sell your interest. We had one client that sold their interest at a premium who someone who wanted to jump the queue. So rather than going in the queue, they bought someone else's interest, but you just don't know.
Let me ask you to change up a little bit. Debt. What do you, in terms of how you select that, the role of debt in your investment decisions? Let's talk about that a little bit. And I guess, frankly, are you looking life companies, CMBS, bank debt? How do you make those decisions? Rachel, you want to talk a little bit about this? You have a little bit of a different twist.
Yeah, well, as I think I mentioned earlier, the debt on a tax credit deal is anywhere from 10% to 50% of the relation to the total development cost. So it's probably more of an inconsequential piece where, again, the subsidy programs really are the drivers. The types of debt we use are, I would say, more often than not from 2 categories. Agency debt, so the finance agency within a state we're working in, so in Massachusetts, the Massachusetts Housing Finance Agency, Connecticut, Pennsylvania, or conventional debt. Do a lot of work with John Wolfe at Bank of America. They're a great partner and a real believer in creation of affordable housing. So that's typically the 2 pools we'll go to.
Mark?
I mean, throughout AEW, we're using all of the above. What I would say, and I think Peter brought up on the last panel, our assets that should probably have the highest leverage, which have the most stable cash flow, are more often in hands of clients that have restrictions on leverage. So, more often than not, it's definitely less than 50%, and a lot of times less than 30%. So I think that is one of the things the lenders are seeing, is as assets get put into hands of people that have less leverage, because they remember the 90s, they remember 2008, but those aren't the assets that got hurt, but they still won't do it. I would say on the Opportunity Fund, I could absolutely leverage it up, as Peter said. We've looked at deals where, especially when you have a lot of non-regulated people back in the business, I could have leveraged 85, 90% at 400 over, maybe 425 over, with really no covenants. We're not doing it, but we're keeping mostly floating rate. And again, it's understanding the debt as an asset, which is what Peter was sitting there saying, which is, I agree with him, everybody should be leveraging up. If I'm lowering my hold period because we can double our money in a couple of years or less than a couple of years, I'm leaving it unencumbered so the buyer can make the debt, the assets, and them and pay me more.
Peter?
So we used to borrow at much higher levels. John McCullough would lend to my father at 75% loan to cost or loan to value. That was a traditional intercontinental deal. In the open-ended fund, we've pushed debt down. We have a 50% threshold. We're actually at 45% in our fund. We believe in relationships. We bank with most of the money center banks and a lot of the friends in the room. We do Fannie executions on apartments. We like life loans on old portfolio family properties because there's longer term hold. One other observation about what Peter said on the prior panel is in a lot of funds per FASB 157 and counting, the interpretation in the last 7 years is new that we all have to mark our debt. And so we can't lever up. It adds huge volatility to our performance. The mortgage is actually appraised every quarter just as the property is. And so, at 45% leverage in our fund, we have a lot more vol than the NCREIF Odyssey Index has. And that can be good and it can be bad, but there's more noise in performance. And so that's something that gives us further caution.
Kathy?
We in the funds cannot put more than 70% debt on any of our investments. I think our average throughout the portfolio is under 65%. I think by historical standards, that's probably pretty conservative. We're mostly bank financing, we're shorter term hold, so we're playing more of the floating rate structure. I might, offer a little different color than the debt panel. We bought some assets where, we went in on the initial buy, capitalizing on at acquisition, and really as we got to know the assets, we, changed our business plan and wanted to do more with the real estate. So we were going to do a lot more capital investing beyond just the acquisition, and getting the banks, in this case, to sort of realizing that we're actually, increasing the value of the collateral. We think we're taking a B- asset and making it, hopefully an A- or at least a B+. So we've improved the collateral, but they're stuck, in a framework of, and have a hard time upsizing that loan, John. And that's not just John.
Actually, up here in the front row, John. It's great.
Yeah, we have assets in Washington, D.C. where we did this, and we bought two, we just sold one off market to an abutter who wanted it for development at $570 a foot, approximately. Our abutting property, where we took the entire face off the building and have put a curtain glass wall on front, and we're going to redid the lobby, fixed all the obsolescence, redid the building, and I think our loan is at $225 a foot, and it's a hard discussion with the lender to get it up. And you're like, well, we just sold right next door for $570. That's less. It's a 45% loan to value. It's an interesting dynamic. So in the value add space, I think it's interesting.
Scott, what do you think?
For us, it comes down to the business plan itself. You're trying to match fund to make sure you line up to your business plan and the holding period expectations that are attendant to that. I don't mean to keep dwelling on holding period expectations, but I love where we're at right now because because we value flexibility. Mark and I financed a lot of real estate together for almost a decade in the 90s. And if there's one thing I learned, it's don't try and finance it for the next generation owner. No matter how smart we thought we were creating value, something we could hand off to somebody else. It just doesn't work. So flexibility is important on exit. And what Mr. Wolf said in the prior panel that I found interesting is the banks are in this phase, given the flat yield curve, that they can stretch and compete on term with the life companies. So I would say in the past I've been dead set against conduits and servicers. Never had a good experience in that arena. Tended to lean towards life companies only because they could give me the term, but now the banks can give me all of that and an in-market relationship person to work things out. Final comment on being kind of provocative. We spend more time underwriting the banks than they spend underwriting us, because the other problem I've had in my career is banks that turned upside down, where they either got bought out and I was dealing with a completely different culture and lending institution, or at times banks that literally failed on me. So we spend a lot of time thinking about long-term who we're dealing with.
Interesting. Well, let me ask you this then, as buyers and investors in real estate, tangibly, are you seeing the underwriting standards softening given all the competition for the banks where they're chasing deals? And I use banks in quotes because it's all sectors. Are you seeing it in the ground now in terms of what you're able to achieve with your lenders?
Our underwriting or their underwriting? Bank
Their
underwriting. Yeah, a little bit. It's more competitive. I mean, there's spread compression. I think people will play a little higher up in the cap stack, not significantly. We're kind of easy at 45% leverage for a darling borrower. But we're financing a deal in Cambridge today that's an old family asset, and we're seeing really heated competition around it, and that's enjoyable.
Yeah, sure. Mark?
Yeah, if you have the right asset, it's like everything in the capital markets. If you have the right asset, there's a lot of money that wants to do it. And, you know, I mean, we all think, and I was joking around, is we all think we buy cheap and everyone overpays. So when you ask the question, everyone's always going to say, sure, we're smart, but everybody else is doing crazy things, not us. It's a very competitive market out there, and you know you have to meet the market. So I think when you look at people's the ways they're underwriting fundamentals and growth rates, that doesn't feel crazy. But then if you buy at a 4 cap rate and so you can sell at a 6 cap rate, they just neutralize everything else, because if there is a monetary policy shift, which is I think one of the things that was either John or Peter was talking to, you know, and interest rates rise, then your NOI has to grow faster than the rise in the interest rate.
Right.
And that's the danger, is the exit cap rates are neutralizing a lot of, I would call them more conservative assumptions that are being used.
That's really the question of whether we're overpaying or not. You know, if you tell me what interest rates are 7 years from now, I'll tell you if we overpaid or not.
Well, then given the regulatory requirements and what's going on then, do you say right now, well, maybe we'll hold back, we'll not make it a particular investment because we want to see when's the Fed's going to stop the qualitative easing? Is that something that you're actually consciously thinking about?
We think of it a little differently. If we feel like apartments are thinning out too much, and you know, there's some sub-5 cap behavior, even some sub-4 cap behavior, we've transitioned to manufacturing, in other words, building instead of buying stable. So we're in the ground in Chicago, downtown. We're about to go in Hoboken, and to go vertical with 200 units. So we can build there on kind of between a 6 and 6.4 return on cost, and a total of kind of 9 to 10 and a quarter. We take that all day long over buying stable in Hoboken on a sub 5.5. So, you know, we're not smart enough to think the way you're asking me to think. You know, we're trying to solve for returns and trying to be creative.
Yeah, I don't think you can be out of the market, but we're trying to structure a portfolio that can, I'll call it, perform in anticipation of monetary policy shift. So whether it's the NOI growth rates, whether it's going, you know, what's everyone's favorite asset class? The one that has the highest NOI growth rate where you can still buy more at trough, and maybe where the capital markets haven't yet repriced it to a place where the starting point, you know, completely neuters all of those, you know, those upsides that you have in the NOI growth, because you need it just to get to there. So that's what we're doing, and you're going to be creative in the way you approach it.
Rachel?
Sure, underwriting standards. So I'm finding it becoming more difficult, but for different reasons. So as I mentioned earlier, the debt is a small component of my capital structure. When I'm determining the initial feasibility of a deal, what's becoming more difficult for me in the past couple of years is the subsidy programs in which we apply for, which are incredibly competitive, are starting to become more restrictive and to a certain extent putting artificial caps, such as limiting the amount of funds a deal can apply for when they say you can apply for X, but the deal really needs X plus 3 million. Or they're saying, moving forward, we only want you to do deals where the construction cost is limited to 200,000 per unit. And the reality is that's not what construction costs are today. So that's really what's making my deals more difficult.
Scott, how do you see, in terms of, you've been listening to some of the things that Peter and Mark have been saying, how does your perspective differ, or does it differ from what they're talking about?
First off, I think that to the original question, I think the panel last time said it, I think that debt markets have been fairly disciplined, more disciplined than I would have expected with this much activity going on. We're able to, again, take a long-term view of the world, so a lot of the stuff we're doing is really zeroing in on assets that are in improving locations, and particularly locations where we can take that 5 to 10 year view of the locations, but the property is anchored down by durable income and credit and finance as well. So we're not taking out interest rate entirely, but we're taking it out in the intermediate term while the building and its location catches up to the marketplace in the event that rates move against us.
And what Scott's doing, I mean, he's doing urban retail, and you're seeing prior benchmarks are being obliterated. You go to New York, you can see, you know, street level retail trading for $5,000 and $6,000 a foot. Chicago just had a couple on Michigan Ave that came close to $1,000 a foot. I mean, these are numbers you've never seen before.
There's an asset across the street that's going to trade at around $2,000 a foot, an office asset being priced today. We also, again, our business is difficult to understand from the outside. Whatever, 26 years of doing this, the game's pretty simple, I think. If you don't over-leverage yourself and you can take a long-term view of the asset, you'd probably have seen above-index appreciation in your portfolio. So what I'm intrigued by is where we get in trouble as a sector is when we move into the mezzy products and some of the funky products. And I'm seeing traditional equity, like Mark mentioned. He's got new clients and new products coming in every day, and they're real equity products. That actually squeezed the mezz out of the market that was starting to become prevalent in 2010, 2011. And that hard equity, I think, is what keeps the game going for us.
Kathy, you want to speak to that? And then I did want to ask, one of the questions I had was about mezz debt and whether or not that's competition for you, or do you see it as helping you, or will you use it? But Kathy, you want to speak to what they're talking about?
Maybe I'll just give a preview on the mezz.
Yeah.
We were looking at a ground-up multifamily development in Stamford to provide JV equity with a very seasoned, well-regarded operator. And you know, with the market in the multifamily first-hand development, it was feeling fully priced. We actually decided that we weren't comfortable with the ultimate exit pricing and actually provided a layer of mezz. And the mezz was priced at about 16%. So, you know, we just took the opportunity that we were given and trying to structure it to a point where we were comfortable in the capital stack where we were.
That's
preferred, wait a minute.
That's preferred equity, you're calling it, Matt,
Yeah.
right?
Yeah.
Last comments on this question or anything that we've missed?
Just want to make an observation. I'm the only one that doesn't work off of a fund. And so we didn't really ever get into it, but I think it's been interesting. I hope it's been interesting for the audience that it matters how you invest, how you get access to the real estate, whether it's indirectly or directly. We just heard a lot of stuff that comes up around various funds, and we've made a conscious choice to stay away from funds and just be a programmatic, you know, one deal at a time investor.
I'll echo that. I don't work off of a fund, and no, that's okay. I work off of other people's money, though. It's the governance. And we also have built our portfolio one building at a time. And I know that I think my comments have come off fairly negative, but I don't want that to be what you think that's how I feel. I think that the tax credit business is an exciting business. Deals have become more complicated. I mean, everybody's deals have become more complicated. It's harder to find acquisitions. So we've just become more creative, working in different states, maybe that we haven't worked in historically, chasing new programs, such as Sandy money that's being, I mean, huge allocations being given out because the governor agreed to move it in a year. So just new ways to do the same business.
Andrew, you get the last word. Andrew Pearlstein from Cypher Shaw, you've organized this and drawn these people out so well. Last word.
Last word is, I think that when you look at the marketplace, you can see how the varying views, how competitive it is, both from an investor side and from a lender side, and that there is a lot of liquidity, chasing deals. And I think, Scott, when you said, you know, making sure you don't over leverage and making smart business decisions is what is the most important thing.
I want to say that I was just past a question even. For those of you who have questions, in the interest of time, I'm going to suggest that maybe the panelists will remain a few minutes and you can have free high-priced consulting. Before we adjourn and officially thank them, I want to recognize our folks on the ground here. Amy Erickson from Pepperell, come on up here. You, who was our queen of logistics, incredible job. Jackie Manzer, who works with Amy on this stuff. And once again, Luke Nichols, come on up so everybody sees your face, because this represents money to you. As you can tell, I skew the average age of our colleagues, you know, by 1 or 2 years. I'm almost a millennial. I just missed the cutoff. Weren't these panels amazing? That first panel on debt, this panel on equity, you're absolutely fantastic. Not just the time and insight and eloquence you had today. It was really fun listening to you. But really, most of all, what you're doing in the market. Thank you very much for that. Thanks for everything. Everyone, please stay.